All right. Good morning, everyone who is on live, and good evening for any of you deciding to listen to the recording of this later on. This is our second quarter investment advisory board meeting to give you an update on everything. Can somebody just confirm you can hear me loud and clear? Okay, I have confirmation of that. So as we get started, I just want to start off by saying this has been a very difficult quarter. It's a lot easier when you come into these calls and you say, "Hey, everything's up a lot, several percent," which we've enjoyed that all of last year, and even as this year started, a lot easier to message to deliver. But I just want to say here at Ankerstar Wealth, we take our position very seriously. The market's going to have its ups and its downs. We certainly expect that on a day-to-day or week-to-week basis. But when you see a quarter like we've just had this first quarter, where the year starts with a lot of optimism, things jump up all to all-time highs, even in the middle of February, and then the last 7 weeks have been very painful to go through, but it's something that we are going to adjust as we go on, and we'll be covering a lot of that today. There's certainly a heaviness of tariffs over this presentation. For any of you reading the papers, watching the news, tariffs are the talk of the town. Everywhere I go, I feel like I'm hearing about tariffs, talking about tariffs, and certainly you'll be hearing some of that today. So as we get started, let me go to our next slide. I'll just start off with our standard disclaimer. This is a financial education presentation. You must do your own due diligence on anything you hear in this presentation. More disclaimer information can be found on ankerstarwealth.com, and the opinions expressed are mine. And I know Steve will be jumping in as well alone. So let's get started with our update. Okay, what do? Make as much money as possible within your risk tolerance and capacity. And I want to really stress that risk tolerance on today's presentation. Last year and even the year before, you can say when the markets are going up and there's little 5% drops, everybody feels higher risk than they may be. But when you go through these last 6-7 weeks, we're going to find out truly if you are in the right risk tolerance. And that's something that we're doing with all of our clients, reaching out. It's better just to look the news and the updates in the face and deal with them directly, but then to make sure everybody is in those correct tolerance levels. So number 2 is where that really plays out. Work through these volatile times to avoid financial mistakes. And a financial mistake may be like, I just want to rush to cash, and then, or I want to, I've had investors say, hey, should we start shorting the market? Those are aggressive changes, and that's certainly the coaching, mentoring we want to walk through, and then ultimately provide that long-term estate tax planning, and even when there's tax losses, to harvest those tax losses. So anyways, we pride ourselves on being rapid response to client concerns, and certainly that's what we're getting to do. We get the opportunity to do during this last 7 weeks. I always like to show this, that it's not Ankerstar Wealth alone, that we work with a lot of partners. On the inner circle are like direct partners that we talk to certainly on a weekly basis, and on the outside is more investments that we may be involved in. But recognize that Schwab, which most of you see your custodian holdings in, or a JP Morgan Chase, or First Trust, or Moonshots. I mean, these are all partners that we're dealing with, and the investments will change from time to time based on what the market allows. Okay, as far as the growth, you can see the graph, and really if you just focus on the graph, it was a nice steady growth up through January of this year. And then unfortunately, you can see that since January, it is our overall Schwab accounts, assets under management, has dropped. And it's not dropped that, clients are cashing out or people are switching from Ankerstar Wealth, it's dropped because the market valuations have went down. So, and I'm sure if you're tuning in for this, you're all very aware of that. Overall, as far as assets under advisement as well, we're at 102 million. I want to say Steve can address, but I think it peaked right at 110, so it's come down a little bit. And we use a variety of stocks and ETFs. Most mutual funds that we have been transferred in. There's no mutual funds actually in our models. And then bond CDs, and then there's alternative investments, which some of you are aware of. So anyways. Okay, so we'll spend a little bit of time on this slide. We'll show our top holdings, how 2025 is going. And as I updated the slides this week, I wanted to just stay on 2024. 2024 was a nice up year. And of course, I like those positive returns. 2025, and let's just say what it is. At mid-February, all-time high. We're slapping high fives. Trump was elected in November. There was a rally based on a nice clean election, quick results. Everyone's excited about extension of the 2017 tax cuts, as well as expected less regulation. Everyone's fired up. The market's ready to burst, and it started going up. And then what happened? Tariffs hit us. And I'm not sure I've ever seen an event quite as, initiated by one person. Like when a COVID hits, it's a lot of things happening. When a great financial crisis hits, it's a lot of things. Tariffs is being driven certainly by our president and those surrounding him. It's not just him by himself, but and there's certainly a reason for it. And I'll be addressing tariffs on the last slide in this deck. But when you look at our overall investments, now cash, USFRs, our cash holding method, is the number one holding. There's certainly always a level of cash that should be in accounts, but that has increased with the current volatility. And then you have, which you've seen in the past, Bitcoin, Apple, Vanguard long-term bonds, business bonds, Amazon, Google, Buffer, which is a buffered holding. It doesn't have quite the ups and downs. Another high yield bond, and JEPI, which is another buffered high income type holding. So, let's just say what it is. I haven't looked at today or much to say, but the S&P down almost 14%, the NASDAQ down 17%. And a straight 60-40 holding would only be down around 5%. So bonds are doing what they're expected to do as far as the yield. However, bonds are under pressure as well with the 10-year bond rate going up, which means bond holdings go down. So it's not quite that easy to just pick where you want to be. As far as some of the things that we are in the process of doing is reducing risk. Initially it seemed like things were ready to fly higher with the tariff concerns. Risks need to be pulled in a little bit, but staying within the current risk tolerance levels for each investor. Another thing that we're doing, and I'll deal with a lot of changes we're making, is augmenting positions, and I just call it the 493. Things that are not the Mag 7, but also not small and mid cap. So I have a slide coming up that shows you that the Mag 7 has done fantastic the last 2 years for sure. But when things go down, it's the first to go down. It'll also most likely be the first to rebound when it goes back up. Other things that we're doing, reducing rate sensitive holdings. And that's what I was talking about with the like the long-term bonds. They're more susceptible to interest rate changes. And one thing that we found is interest rates, if you looked lately, they went down initially in the last 2 weeks, but then they've come back. And some of that's the result of, it could be, we don't know for sure, but China selling U.S. treasuries causes the interest rates to go up. That if you purchase a home or refinance your home, you're certainly more aware of these interest rates jumping around. And then one other thing I want to cover here is implementing more of a Bitcoin strategy to capture profits but also limit some downside loss as Bitcoin can move quite a bit. Bottom line, and I just have this down here, recession chances have doubled from what we expected. Goldman Sachs raised their forecast on a recession to 45%, and JP Morgan Chase raised theirs to 60%. Initially coming in this year was more around 20%. And feel free to put any questions you have into the chat, and we'll make sure we get those either during the presentation or at the end. Okay, so my slide from a quarter ago, we had a soft landing. We did. I know I felt it. I know the Fed, I didn't talk to Jerome Powell, but I know he felt it. The soft landing had occurred. We were there. And, Steve's more on the pilot side. I think we just did a touch and go. So we had the soft landing, came down, but the plane's going back up. A hard landing is back in sight. We touched down, and it is caused by the tariff uncertainty. It might not be directly the tariffs themselves, but the uncertainty that it's added to the market and what it's doing to U.S. companies that have international exposure. Think of an Apple that gets a lot of iPhones manufactured in China and other countries, as well as U.S. countries like, take a General Motors where they assemble vehicles across the border in Canada or Mexico. And now you have this tariff uncertainty out there, and it's causing supply chain problems, just like COVID did. So if there's a recession, that's 2 quarters of negative GDP. I've heard a lot that quarter number 1 is very likely to be 0 or negative, and same with quarter 2. So we may already be in that recession that we talked about. What that means, contraction in spending and unemployment rate going up. Unemployment rate's gone up just a tiny bit. You'll see in a few slides. Okay, as far as investments, and what I try to do here is things that are in green seem to be doing well or decent as our expectations. Things in the yellow are kind of like a little disappointing, and things in red are highly disappointing. So first of all, CDs, low risk dividend stocks, secured lending all have done fine. High yield bonds with higher duration have not done well with interest rates going up. In artificial intelligence, I'll be honest, it just hasn't, the NVIDIAs have surged up and come back down. And you're seeing some other stocks move accordingly, certainly in the semiconductor industry. The things in the green have done better. Banks, infrastructure, digital advertising, housing stayed up. One big one in the red that affects our portfolio a lot is that S&P growth, well, really within the Mag 7. So, the Mag 7 has come down the most. So our starting lineup I've made a few adjustments in there. You can see the best of breed tech. We still have that. Haven't lost confidence in any of these that I'm like, oh boy, we need to exit this. But we're adding some diversification beyond those 7 or the top 7. Further augmentation, we saw in January an early surge in international. It's come back down some, but it certainly makes me realize that as the economy is affected worldwide, there's going to be some winners and losers in this international economy. So we're going to look to pick up some positions there. And anyways, that's that. Okay, so a quick review. Unemployment up to 4.2%. Labor participation rate went up a little bit. So even though like a week ago, the 228,000 jobs added, the unemployment went up a little. So the jobs added was a good number. Unemployment went up more. The participation rate, that's a number we're gonna watch when that, right now at 4.2, but that if it starts to get to 4.5, it's going to cause the Fed to really consider making some adjustments. So continuing to watch that. Oh, I just lost. I'm sorry about that. Go back to our slide. Inflation. So we saw some good news on inflation yesterday. I woke up, or first piece of news that I saw, inflation down to 2.4%, core inflation at a 4-year low. I was all excited. Markets are going to scream higher. They didn't. Still that over Fed, or the tariffs kind of taking over the news. But the good news is inflation hasn't seen a tick up yet. And that's the biggest concern with tariffs, is that it will cause inflation to go up. As long as inflation keeps tracking down, it gives the Fed the ability to make adjustments with the discount rate and such. If we see the inflation go up, then the Fed's hands are going to be tied until we are really in a recession. And actually, another headline I saw yesterday that'll make people happy, and I've said this before, we're never going to get our prices back to what they were 5 years ago, but the prices fell for the first time in nearly 5 years. So, I mean, and they didn't fall far enough back, but they at least went down a little bit. So that's kind of good news. Okay, I always update on inflation. What's causing the inflation? The biggest two still continue to be shelter and auto insurance. Shelter is the dark blue line, but you can see it's declining. So that means it is increasing at a slower rate. And really, shelter is going to drive inflation. In a few slides, we'll look at housing prices. Auto insurance continues to, be high, 11%. I mean, if prices go up 11% year over year, that's a lot. It's down from 20% year over year. But if you're a person certainly that has kids in your house, or you own a business that has trucks or cars as part of your business, auto insurance can be very painful. So anyways, and part of the reason that goes up is because cars are more expensive and more expensive to fix. It's not as simple as just making a small change. When you fix a car, it's very expensive. So auto insurance up quite a bit. How much will the Fed cut rates in 2025? They're still projecting 2 rate cuts or 50 basis points. I have heard things the Fed will cut rates anywhere from 0 times to 5 times. It averages out to 2, but people are saying it will either be 0 or 5, or it'll be 0 or a lot. Either the Fed's going to be able to cut rates, or they're going to have to cut them a lot because we went into a recession, and they're trying to assist with some stimulus. So, but 50 basis points is the average. So where that goes, and that's also part of the reason why we need to change our duration on our bonds, because we don't know this kind of information. It could go one way or the other. Okay, so here is the ugly chart of tariffs. You can see through mid-February, like things peaking up. That pink line that stands at the top is the NASDAQ. So that one's, very exciting. And the yellow/blue line is the S&P 500. They were doing fantastic. And you can see that in March, it was a house of pain as far as the drop-off. I would say that they have exceeded expectations for all of 2024 and into February. No one was complaining about those at all. But since then, they're down 10 to 15%. So even when we look at year to date, you may say, well, it's down 10%, but they were up 5 to 10% into February. So the drop. Okay, I brought this slide up again. This slide was in last quarter's deck, and I think it's important to just kind of remember history. Wall Street was expecting a 12% gain in the S&P 500 this year. That was the average. You saw the most aggressive people, Oppenheimer, 20%. Boy, that sounds like a great number. The least aggressive person, Cantor Fitzgerald, 1.9%. At this point where the market is, we would all be very happy with Cantor Fitzgerald's 1.9%. If the market ends up 1.9% S&P 500 in the year, I think all of us will be like, yeah, I'll take that. That's a good year. But 3 months ago, we would not have been happy with that. I know that I'll even put, I had down 8 to 10% expecting. I didn't expect 12 just because I thought of it a regression to the mean. So I just put this down as reviewing the optimism of a quarter ago. I'm not sure I'll show this again, but and then the headline on the left, I really like. Wall Street is at it again, making irrelevant market predictions. And optimistic guesses about the future are not forecasts. So it's just good to call out. There was an optimism. Certainly, realism is hit. I know, I don't know which boxer said it, Mike Tyson, George Foreman. Somebody said, we all have a plan until you get hit in the face. We did not know, we thought we were going to get tax cuts and regulation relief, but we got hit in the face with tariffs. These are smart companies that we're invested in, best of breed. Once the tariffs are sorted out, whether they actually stay in place or they're just a negotiating tactic, these companies will all do well. They will survive. They will adjust to the new rules of the game. But right now, the rules are changing, so they can't make good decisions until we get some solidification there. Okay. Election year volatility. I brought this chart up. The expectation is that volatility goes down throughout this first election year. We are here, but our volatility is off the chart of this. It is over 40 for the VIX. So that is a fear index. Expected a little bit of increase after inauguration, but we've had a lot of increase. Okay, Mag 7. So everyone likes the Mag 7 when it's going up. A lot of you hold Apple, Google, Amazon, NVIDIA, Tesla through a Texas Capital's holding, Microsoft. You hold those stocks. And what was happening is the Mag 7 weight in the S&P 500, if you look in the chart in the upper right, it was increasing higher and higher. And you can see it was abnormally high as far as and what is normal. Normal might be 25 to 30% of the weight. It had touched like 38%. That has come back as of a week ago. It was down to 35%. The expectation is beyond the next 490 stocks, I'll say, are going to either increase and start to catch up with the Mag 7 or top 10 stocks, or the top 10 are going to reduce and kind of go more in line with the S&P 500. So you're going to see some adjustments in models that reflect this. And we already made some adjustments in the third and fourth quarters last year, reducing the overweight of those top stocks somewhat, but they still continue to be overweight. They are still fantastic companies with a great future. Okay, this slide is one of my favorite slides I like to show, especially during tough times. The gray bars are what the annual return is, and there's times the annual return is negative. And the red is the greatest intra-year decline. So take a year like a COVID year where the greatest, the market was down 34%, but by the end of the year, it ended up 16%. So, let that sink in for a second. Your portfolio was down by a third, but if you just left it in there on a normal investment, it would be up 16%. Right now, and this was, from a week ago, we're down like 14%. So we are definitely in that red, down 14%. We don't know what the year's going to end up. But when we look at the last 5 times, and when I tried to look at the last 5 times, we had a 20 plus market decline, because at one point we were down 20%. The market returned 19, 16, -6, plus 26, and -38. So, the last 3 times or 5 times it was really down a lot, 20%. 3 out of 5, it was up by the end of the year. And only 1 was it really down, still pretty bad, and that was in the great financial crisis. Another, and I love positivity. So what I looked at is the following year after that 20% decline, what was the market? Up 23, 13, 29, 27, and 24. So we are in the year right now where it is down, has been down 20%. And I'm saying that there's a chance that it gets up to positive, but then the following year, at least for the last 5, and I didn't go back and analyze 50 years of data, it ends up positive. And certainly we want to invest that way. We're not looking to go to cash and just sit this out and earn a treasury type return. We're looking to invest your money wisely. Mortgage rates, and the one graph I want you to study is the bottom one, which shows the median sales price. And you can see the price since 2004 has certainly went up and up and up and up. But the last year, it looks like it's starting to come down a little bit. Where does this matter? Shelter cost in relation to inflation. If this continues to come down, that means the core driver of inflation comes down, which allows the Fed to operate more normally. If this goes up, which I get it, as a homeowner, we always want the value of our house to go up. I mean, we certainly do. But if it goes up, then inflation goes up and the Fed's hands are tied. So it's just the important part there. Okay, tariffs. So we'll spend some time on tariffs here, since I'm sure that's what many of you dialed in to hear about. Coming into this year, the U.S. tariffs, and I listened into a J.P. Morgan call earlier today. You know, tariffs were 2.2%. The United States charged 2.2%, and outside we were charged 4.6% on average. And I know there's a lot of different formulas, and even I saw the chart that Trump brought out last Wednesday, and there's some questions on that data. We'll just say, but 2.2% is what we had been charging, and 4.6 is what had been charged us. So when the idea of reciprocal tariffs came out, the belief, and if you remember going into Wednesday, I felt optimistic. I was like, oh, this is going to be good. We'll get this thing figured out. The belief was, well, maybe they'll add another 2.4%. So it'll be 4.6%, just like we get charged. That would be a reciprocal tariff. And the market could stomach that. But what came out was something that was way higher in scale, and it still continues on. So we heard 10% was the minimum, and then you saw the charts. European Union was 39. It was a whole different scale higher than expected. And even on this graph that I show here, this just shows an average of 8 to 10%. That's still way higher than we've had since the 60s. So what's the danger with tariffs? They charge more coming in, which the costs, ultimately, we know costs are going to get passed on to the consumer, and it can cause inflation. As far as opinions on tariffs, they're a tool from the past, but I've heard it described as, throwing a hand grenade into a room in which you're in there too. Yeah, it may take out the enemy, but it may be taking yourself out as well. And ultimately, when I heard the tariffs that started 2 months ago, and I heard Mexico, Canada, and China, the belief is, we're targeting Mexico and Canada a little bit, but China truly is the real target. China has the biggest exports to the United States. We export to them probably 1/3 what they export to us. We provide the market. They're selling the products here. We have an advantage. Canada and Mexico, obviously our neighbors, a lot of companies very close by, a little bit more aligned with us. So, when I heard those tariffs come out, I believe, I was like, China's really the target. Mexico and Canada are just kind of starting in this. But what was rolled out last Wednesday, and it's only been last Wednesday, was 180 countries. And to try to negotiate with 180 countries, extremely difficult. So we saw a rollback, a 90-day delay, and that's all it is a delay to try to get this negotiations complete. Ultimately, do we believe these tariffs are going to stay in place at this high a level? I mean, everyone can have their own opinion. I believe it's a negotiating tactic. The problem is, even when this negotiating tactic goes away, the supply chain shock has already happened. Countries that were kind of operating peacefully with us are now not as sure what to do. And so there can be a long-term implication. Recession, country by country, would have to be evaluated, but we can create recessions in other countries. And obviously the tariff, unless some news came out in the last 30 minutes, has continued with China up over 100%, which is effectively an embargo. So, feel free to put your questions in the chat for this, because I'm sure there'll be some questions on tariffs. I did think there was a comment that was pretty funny that, I thought it was funny. China targets Hollywood films in retaliation of tariffs. And Trump's response was, I think I've heard of worse things. So if you think of what we export to certainly the world, but to China, technology, the Amazons and Apples and the Googles and technology we export, but we're not exporting manufactured products, not nearly as much. I don't think there's a huge set of General Motors cars made in the United States and shipped to China. So retaliatory tariffs on us it's not super effective. So I'm kind of surprised they haven't come down a little bit. But what we do is we do export Hollywood movies and ideas and things like that. So we'll see where all this goes. And then last is kind of the forecast. I put near recession, but I fully expect, I'm kind of leaning with Goldman Sachs and JP Morgan Chase that we're likely to touch a recession, which means 2 quarters negative GDP. It would be, we are in it now. And we just won't know it till the numbers come out in July to see 2 quarters. Monetary, 2 rate cuts, I fully expect it could go up to 4 or 5, with that, if inflation stays in check. Mortgage rates, if inflation goes up, the mortgage rates, unfortunately are not going to drop as much as we had hoped. GDP projections, originally our projection was for 2 to 2.5% this year. Overall in the year, it's going to be less than 1% would be the projection. As far as volatility, originally, every consensus of the market was 12%. I just put down our forecast of getting back to 0 would be reasonable. And I like to end on some positivity. And that bull on the lower left, the Wall Street bull, he's not dead. He's sleeping. He's laying down. He's tired right now. But that bull gets back up again. And then with Trump releasing what's going to be the most unpopular plan first, which I can't imagine he's going to come out with anything more unpopular than tariffs, but to follow with tax extension relief from 2027 or 2017 and regulation relief, can lead our companies to do better and feel better, and then essentially the economy to move forward. Tariffs can go one of 2 ways. I've heard this, a year from now, they're either going to be really good for us or really bad, but we just don't know which. If you see other countries starting to drop theirs and say, hey, we'll go to 0 for 0, that's going to be good. You're going to start to see some other countries become trade partners with us. But if we get continued trade wars with China, and it's definitely not a good thing. As much as the idea of bringing all those jobs back to the United States, our unemployment rate is 4.2%. Our labor participation rate is like 62%. We do not have millions and millions or a billion workers to take over all these factories. So there is an appropriate place for certain types of manufacturing to be done. And usually it is the least expensive place, the most efficient place will give the most benefit to consumers. So that's what we have. We'll bring this up to questions.